Good morning, y'all. Good morning. All right, we will go ahead and get started because we got a jam-packed class today. So today is going to be all about futures. It's going to be the Futures Masterclass. And let me go ahead and share my screen so we can jump right into it. This is going to be the beginner's guide to trading futures with prop firms specifically. So I know a lot of us are interested in that. Some of us have already dabbled in it, and then some of us have not at all. So this is going to be good for complete beginners and people that are already doing it. Today, we're going to go over what are futures, why traders choose futures, how prop firms work, risks, rules, psychology, trading frameworks, and then at the end, we'll do a Q&A. First, what are futures? Now, don't spend too much time trying to understand, oh, but what does it mean to have a contract and an asset and this and that? Y'all, we are really just trading price. We are not super interested in the contracts and actually what we're trading. And are you really signing up to buy oil for real? And we're not really concerned with that. We are just trading price. But for those that are interested in the background of futures, how futures came about, and why futures is even a thing, this is what it is. So, futures is a contract to buy or sell an asset at a set price. We are not owning these assets, meaning we are not buying these contracts and holding them through the expiration date and therefore owning what the contract is. We are getting in and out and just trading price. Some common markets of futures are the indice market, ES, which is SPY S&P 500, NQ, which is NASDAQ, NAS 100 for the Forex people, and QQQ for the options and stocks people, and YM, which is the Dow Jones. Those are the popular ones. I also like trading M2K, which is the Russell 2000, which is the small cap stocks. Commodities are also very popular with futures. So you have crude oil and gold. Those are the big ones. But you can also trade crypto on futures. And then you can also trade silver, which is really popular right now as well. So there's a lot of different things you can trade on futures. Honestly, if you're used to trading Forex, pretty much the same things you can trade on Forex, you can trade on futures. Futures are traded on a centralized exchange. A futures contract is also called a product code and has symbols in the contract that represent different trading instruments and monthly expiration dates. So on your trading chart in the top right corner, if you're using TradingView to trade, or if you're using Tradeify, it'll be at the top. You'll see these codes, which is just letters and numbers, but they all mean something. So you may see something like ESM24. This is a E-mini S&P 500 futures contract that expires in June 2024. And we'll get into how you can read this a little bit later. But just know that futures is leveraged price movement, not stock ownership. So that's going to be a big difference between futures and stock share trading. Why traders choose futures? There's a lot of reasons why you may have noticed that options traders, Forex traders, day traders with stock shares, they have moved over to futures. It's because it's really a good gig. It's a good gig right now, especially with these prop firms and all the perks of prop firm trading. Futures is really the easiest, the cheapest, and the fastest thing to get into. It has really become that in the trading world. So a lot of traders are choosing to just trade futures. Some other reasons why is because there's no PDT rule. So when you are stock share trading or options trading, you have to deal with something called the pattern day trading rule, where if you have an account under $25,000, you can't do unlimited day trades. So you either have to have a cash account where you can only trade as much as your cash balance is up to your cash balance. And then once it's done, you have to wait the next day to trade more. Or you have to have an account that's over $25,000 to be able to trade unlimitedly, which is where you really unlock just unlimited money when you get to that level. But with futures, doesn't matter how much money you're starting out with, you can keep getting in, keep getting out, keep getting in, keep getting out. Your balance replenishes after every trade. So after every buy and every sell, that money that you made, you can use that money to trade again. You don't have to wait for that money to settle for the next day for you to trade. You don't have a cap on how many trades you can take. You can trade an unlimited amount of times with your revolving balance. So that's a huge thing. Also, there is one clean chart. Unlike options, you have all these different charts and you have the options chain. You have to worry about expiration dates and Greeks and all these things. You don't have theta eating into your profits. You don't have delta deciding how much money you can make. It's just straight price action. If it's above that level and you're in for a buy, you're in profit. Simple. They take the commissions and fees after you've closed out the trade. Now, it is also highly liquid. It moves a lot. It moves quickly. Some charts more than others. Some charts are slower than other charts, depending on how many people are trading it. But the big names like ES, NQ, those move very fast all the time. MGC, which is gold, very highly liquid. So this is for traders that want to trade all hours of the day because it's also open 23 hours out of 24 hours a day. I meant to put that on the list here for why traders choose futures is that it's almost a 24-hour market. The only time futures is closed is from the hours of 5 p.m. and 6 p.m. Every day it closes. And then on Saturdays it's closed, but then it reopens again at 6 p.m. on Sunday. Clear structure and rules. Now the rules are going to depend on the prop firm you're using, but futures itself has very clear rules. Have the amount of margin in your account available to purchase or to position yourself in the trade, and you're good. Very clear, simple rules. So this works really well for momentum traders because it moves so well and so fast. This is great for people that fast markets won't get psyched out because with it moving fast, you have to also take into account that it's going to move fast both ways. And just as quickly as you're in profit, you can get out of profit and vice versa. But being able to have the stomach, the nervous system, the patience to wait it out and ride some of these roller coasters, this will be good for you. Now, I mentioned margin for a second. Now, with futures, you're going to hear the term margin and leverage, similar to Forex, where you would hear these terms as well. The difference between margin and leverage. So what is a margin? Futures margin is the amount a trader must deposit with the broker at the time of entering a futures contract. It is a set percentage of the overall contract value. So think about margin as the price it costs to sit at the table. Now, each futures commodity, each futures asset costs a different amount to position yourself. So let's say you just wanted one contract, buy or sell, doesn't matter. If you wanted to buy one contract of MGC, which is micro gold, it may cost $5,000 to buy that one contract. So you need to have $5,000 in your account to just buy that one contract, right? So it's how much it costs to position yourself in these trades. It costs a lot of money. They all have set values and set prices. You can find that chart on the CME website. They have that chart up for each and every futures contract. It tells you exactly how much margin you need in there if you're day trading, and then it'll tell you how much margin you need in your account if you're going to do overnight trading. But we don't have to worry about overnight trading because most of us are using prop firms and they don't allow overnight trading. So you're just going to need to know the initial margin, which again, if you're using prop firms, doesn't matter because you're going to always have that amount when you are using prop firms. Most prop firm balances start at 50K. Some of them go as low as 25K, but that is enough to get these contracts. And then each prop firm has contract limit sizes, and those limit sizes are not just because the prop firms set you up with a limit on how many contracts you can buy because that's how much you can literally afford with that account balance value. So again, we won't have to really worry about this with prop firms. All that's calculated in when you use prop firms. What is leverage? Leverage is a tool that enables traders to take on positions much larger than their capital. So similar to Forex also, where you would get one lot of something, but it's really like getting 100 of it because it times 100 leverage. So basically what that means is, let's say that to get a contract of whatever, it's $5,000, you would think that means that I'm able to only move $5,000 in the market. No, you're able to move much more than that. So the amount of leverage that they give you per contract, I personally am not sure about that amount. I think it differs for each one, but just know it's a lot. And leverage can work for you and against you, which basically means if you go up just a little bit and now your money is times 5, that's great when you're in profit. But if it goes down a little bit, it's times 5 against you. So leverage works both ways. With futures, every sell is a buy. So they cancel each other out. Meaning on one chart, you cannot have a buy and a sell open at the same time. That's a big difference from Forex. With Forex, you could have a buy open on NAS 100 and a sell open on NAS 100 at the same time, and they would just cancel each other out. You wouldn't be making any money, but you wouldn't be losing any money either. With futures, you can't do that. If you are in for a buy, if you click sell, it'll close out that buy order. If you're in for a sell and you click buy, it'll close out that sell order. So some points to remember are the margin is the minimum amount required to trade futures. So think of the margin as just how much it costs to position yourself in these trades. Margin offers leverage, which allows a trader to trade with more money than they actually have. And leverage can increase your returns, but it can also lead to significant losses. So risk management is definitely a must with futures. The key differences between futures, stocks, and options, very simply put, with stocks, you are buying and selling partial ownership, aka shares, of a stock market company. With options, you are buying and selling the right to own shares, which they call contracts, of a stock market company. With futures, it's a contract to buy or sell an asset at a set price. So you're not owning anything at all. You're just getting in and determining a price of something, basically. You're bidding on something, essentially. So think of futures like leveraged stock shares that use the vocabulary of options and require margin like Forex. That's how I like to think of it. I think of futures as the best of all of the different types of things that I trade. Futures, just call it that in one. Now, back to how you can read these future symbols. So a lot of people trade crude oil. I personally have not looked at an oil chart in years, but I may get into it. I don't know, y'all. I don't watch the news, but I hear this stuff going on with oil. So I may actually look into the oil chart soon. But that ticker symbol, it starts with CL. And then you have gold, which starts with GC. E-mini S&P 500 is ES. Micro E-mini S&P 500 is MES. So any micros, you're just going to put an M in front of everything. Just put an M in front of it. And that's the micro version. Then you have the E-mini NASDAQ, which is NQ. The micro E-mini NASDAQ, which is MNQ. E-mini Dow Jones, YM. And micro E-mini Dow Jones, which is MYM. These are also the codes for the months. Each month has a code letter, and they don't change depending on the year. The year is going to be what's at the end of the product code. So this right here is messed up on my picture, but how you basically read it is these first 2 letters or first 3 letters, if it's a micro contract, is going to be the actual name of the contract, the asset that you're trading. And then that middle 1 single digit letter is going to be the month that that contract expires. And then the last 2 digits are going to be the year. So how you read this is an E-mini S&P 500 contract that expires June 2024. And you see M is the code for June. Right now we are in January. So a lot of us are trading charts that have a G or an H in it. If you're trading with prop firms, they will automatically move your chart and contract chart that you're trading over to the next code. And it'll let you know, it'll say, okay, we're switching you over to H, we're switching you over to J as the months go on. So you won't have to worry about this. Like I said, with prop firms, a lot of this stuff is already handled for you. The risk management's built in, the rules are built in. You don't have to worry about switching your contracts. You don't have to worry about so many things with these prop firms. It's already done for you. Okay, futures contract basics. Before you trade futures, you need to understand how they move, because then that'll make you understand how you get paid. You're going to hear different things: tick size, points, and contracts. Those are going to be like the main terms that you hear with futures that you don't hear other places together. A tick size is important. You can even set your loss and take profit up with ticks. Some of you guys have probably noticed that when you're in Tradeify, but maybe just haven't clicked on it because you don't fully understand what ticks are. But ticks are actually a really good way to value and measure your profits and your losses. A tick size is the smallest possible price movement a futures contract can make. So think of it like pennies in the stock market. An ES tick is 0.25. An NQ tick is 0.25. MES, 0.25. MNQ, 0.25. Price moves in ticks. Points are also in futures. A point is made up of multiple ticks. And this is what tells you how much money you make or lose when price moves. So one tick is 0.25. That means 4 ticks is 1 point. So for every point, it has moved 4 ticks. Okay, so you may hear people talk about, oh, I caught 2 points or I caught 40 ticks. 40 ticks is 10 points. And you can calculate how much money someone made on that because each chart has a specific dollar amount that you make per tick. So your contract size is how much each move pays you. So each futures contract pays a set dollar amount per point, like I was just saying. Mini contracts, which is ES and MQ. Minis have no M in front of them. Micros have an M in front of them. I know it's confusing. I was like, okay, if this is a mini, why isn't there an M in front of it? Micros have the M in front of it. Minis have no M in front of it. So if that's a mini, then what's a regular? There is no regular. There is no regular. It's only minis or micros. So for mini contracts, ES, it moves $50 per point. Now remember, 1 point is 4 ticks. For NQ, it moves $20 per point. Micros is going to be a tenth of that. No matter what chart it is, it's going to be a tenth. So MES is $5 per point, and MNQ is $2 per point. Okay. The biggest difference between micros and minis, a little chart here. Micros contracts are 1/10. It's always going to be 1/10 the size of a mini. Micros contracts are safe for beginners. I think I mentioned in the Discord, maybe I've mentioned on Instagram, but I only trade micros. I do not trade minis. I don't care. I don't care. I don't care. I am not comfortable with the way minis move. It's too much. I use a higher time frame. So I'm holding for a little bit of a longer movement. I'm not scalping like this much. I maybe like this much. And so I'd rather scale in with micros than have a mini. That's just me. Micros contracts allow for scaling. $5 per point for MES, $50 per point for ES. Micros is perfect for learners. Minis are meant for pros, and then also hyper scalpers, because you cannot hold a mini for too long. It'll go, as soon as it goes against you, it can blow everything up. And I'm not comfortable with that. All right, so here's a good chart. Here's futures contracts versus the chart movement. Let's talk about NASDAQ NQ. For a mini, $5 per tick or $20 per point, because it's times 4, because there's 4 ticks in a point. Let's say you buy an NQJ24 contract, and that NQJ24 contract goes from 1550 to 1570. That's a $20 difference, but a dollar is points when you're talking about trading. So it's a 20-point move. That's $400 profit on that one contract because you're getting $20 per point. You can think of it in terms of dollars because a point is a dollar on the chart. So if the NASDAQ chart moves $20, it's moved 20 points. And 20 points, $20 per point, that's $400 profit on that one contract. S&P 500, yes, it's $12.50 per tick or $50 per point. So you got times it by 4. Let's say you buy an ES24 contract, and that contract goes from 5,300 to 5,290, 10 points down. So that was a 10-point move, but that was a $500 loss because you got in for a buy. So you needed to go up, but it went down $10. It went down $10, went down 10 points. It's $50 per point. That's a $500 loss. Traders like trading NQ because it moves faster than ES. Even though you can make more money, but also lose more money on ES, ES is a little bit slower because it's taking into account the top 500 stocks in the stock market, where the NASDAQ is only taking into account 100 stocks. And it's also very tech heavy. All that movement is great for traders. Now let's talk about gold. Gold is measured a little bit differently because it's not tied to the stock market. It's a commodity and it's a physical commodity. So it's actually measured a little different. $10 per tick for GC, which is $100 per point. So for gold, it's times 10 with the ticks, not times 4. So let's say you sell a GC Q4 contract. And again, you'll always see me doing MGC, not regular GC. I'm doing micro GC. and you'll see why. It's intense. So a GCQ4 contract goes from 2425.3 to 2400. You sold it, so it going down is good. We have 253 ticks, which is going to be 25.3 points. It's $100 per point. So you got to do 100 times 25.3. That's $2,530 profit on that small move on gold. Okay. This is just for the math people, right? This is for the people that really want to understand, well, how am I making this much? How am I losing this much? This is the math behind it on the top three charts here. It gets intense with some of these numbers. Having to calculate takes points, and then gold moves differently than the other things, and then oil's gonna move differently from these, and then micros moves differently. It can get confusing. Luckily for us, we don't ever really have to do this math. All right. We don't really have to do this math. But this is just for people that want to know what goes into some of these calculations. Now let's get into what is a prop firm. A prop firm is a leveraged opportunity. If you have a strategy, risk management down, and emotional control, a prop firm can be one of the fastest and safest ways to trade futures seriously. On the opposite end, if you do not have a strategy, if you do not have risk management, and you do not have emotional control, you will waste so much money. You will throw money down the drain on evaluations, resets, completely buying brand new accounts. Okay, blown. So I actually came across a thread post where someone was like, be honest, how much money have y'all spent on prop firms? The numbers were yeah. Okay, there's people that have been spending their checks on prop firm evals, prop firm resets, replenishing blown accounts for years and still haven't gotten a payout. People like, yeah, easily spent 10K on prop firms and haven't made that money back yet. There's a cheaper way to learn futures. You don't have to be spending this money on prop firms to learn futures. You can demo trade until you got something. It's a strategy that you're willing to risk some money on. But if you're learning, don't learn with prop firms. You can learn with demo trading. A futures prop firm gives traders access to funded futures accounts. Instead of depositing upfront tens of thousands of dollars, because that's what you need to get even a small one contract of a micro, you need tens of thousands of dollars, okay? Instead of you starting with your own funded account with personal funds, you pay a small monthly fee for these evaluations. You choose a firm and you choose an account size, and then pay the small monthly fee that's associated with that account size until you pass your evaluation. An evaluation is just a challenge. It's also called a challenge. You'll also hear it called a combine. But basically what that is prop firm is saying, okay, we'll give you access to this $50,000 in capital if you can make $3,000 in profits, not go over 15 contracts at a time, not trade overnight. Can't think over the top of my head, but it's a list of rules and regulations that you have to follow. Okay. Not have a certain amount going to draw down at any point ever. And once you check off all those boxes, then you will get granted that account. And it can take as long as you want, but you are charged a monthly fee. So if it takes you longer than a month to pass the challenge, after a month, they're going to charge you again until you pass the challenge. So that's how you can really rack up these fees. So that's another thing too. Don't do a prop firm challenge until you're ready to commit and dedicate to passing it within a month. You don't want to carry these fees month to month. It's going to end up just being a waste or you spending more money than you have to. So after you get the evaluation, you have to prove that you can trade responsibly, follow the rules, daily loss limits, drawdown, consistency, all the stuff. It'll have it all written out. Then you get to trade with their money once you get funded and pass their requirements of the evaluation. After you do that and trade with their account, then when you make profit on that account, you get to keep a percentage of the profits when you withdraw. So you get to withdraw your profits while risking very little personal capital. Now, a lot of prop firms, a lot of traders will make it seem like this four-step process is very quick and fast, and it's not. It's not a fast thing. It's going to take a little bit of time for you to get comfortable with the firm, pay for the firm, pass the evaluation, then get the funded account, and get enough profits in the funded account to be able to take a payout. Because you got to have a whole new set of rules that you have to follow once you actually get the funded account. then get withdraw, like the process. It's gonna take a minute. It's not a 3-day thing. But with all that being said, why beginners start with prop firms is for these reasons. Lower personal risk. For example, an $89 evaluation fee is much less risk than $10,000 of your own capital with a self-funded account. Okay, so your downside is capped. If you blow the account or you blow the evaluation, you lost $89 instead of thousands of dollars of your own money, right? It has built-in risk limits. Now, I'm gonna be honest, the reason why I was not really here for futures, I was planning on getting into futures and self-funding. That's what I wanted to do. But then I was just like, hold on. What happened? Little side story here. What happened is I went to a trader summit in Dubai in November of 2024, and they had this trader panel on the stage, very successful millionaire traders. And what I also learned is that it takes years to become a millionaire trader. These were traders that have been in it for many, many years, and they were finally at the level of millionaire status, verified, and all of that. All of these millionaire traders that were on this panel, coming from different parts of the world, this was in Dubai, so we were all coming from different places. Every single person on that stage used prop firms. Every single one. These are millionaire traders still using prop firms. And I was like, all right, I'm about to start using prop firms. Because I was naive and ignorant in thinking that, oh, if you're using prop firms, that means you don't have money. That means you're smart. Using prop firms is smart because you're not risking your own money. Why? Risk your own money. Trading smarter, not harder. And you get access to way more capital than you could ever build up yourself or ever should want to build up yourself because you get to max out funding allocations with all these different firms. These were traders that had 20 Apex accounts, 5 Top Steps accounts, 5 Tradeify accounts. They had maxed out the maximum amount of accounts you could have with each prop firm. So they had access to millions of dollars of trading capital every single day. And they were getting payouts from all these different prop firms. And that all adds up. I started thinking completely different from there. I was like, all right, I'm going to go the prop firm route. And that's what I decided to do. I decided to go to prop firm route. Now, it took me some more months to actually get into it and all of that. Because as you guys know, I was pregnant also. So things were more priority to me. But once I was able to really sit down and really focus on learning futures, learning all these different prop firms, learning how they work, trying them out, I was like, yeah, this is the way to go. And I also didn't want to do it initially because I was like, I don't want to follow these rules. These rules are so strict. I don't like following rules. I didn't get into trading to follow somebody else's rules. It's like, why do I want to do that? But actually, having to follow these rules has made me a more disciplined and better trader. It was annoying at first, but over time, it makes you more disciplined. Okay, and that's my point right here. With these built-in risk limits, the rules are strict, but it forces discipline and rule following, which ultimately makes you a better trader. Another reason why beginners start with prop firms is it's scalable without adding capital. You never have to add money to your account, right? And replenish your starting balance or have to worry about, oh, I don't want to take a payout this week because I need to use that and reinvest it into the account. You don't have to worry about that. The account is already built up to the point where anything over that 100K starting balance is yours. You can feel okay with taking that out. Here are the common prop firm rules that you'll have to follow, and each prop firm is different for the actual numbers that these rules are going to be and follow. But each prop firm is going to have rules regarding or rules surrounding a daily loss limit, maximum drawdown. They're all going to have consistency rules, position size limits, different payout policies, different trading hours restrictions. Now, I had mentioned that futures is closed between the hours of 5 and 6. There are some prop firms that make you close out all your trades at 4:10. There are some prop firms that make you close out all your trades by 4:59. So each prop firm is going to be different. It's really important to actually go through the rules section, go through the Zen desk section of the website, the help section, talk to the live chat, because you got to follow the rules. Write them down and look at them every day until you memorize it. Okay. These prop firms I already have memorized because I had to, right? Money is literally on the line because as soon as you break a rule, they close your account. So you don't want to break any of these rules. And the number one reason why traders fail prop firms is for overtrading, hitting that daily loss limit or that maximum loss limit. Revenge trading, again, hitting that loss limit, ignoring daily loss limits, okay? Focusing on, okay, overall loss limit is $5,000 in this account, but the daily loss limit might be $1,000. And if you hit that $1,000, you lost the account. Trading out of boredom, aka stopping when you're ahead or not trading, we got to get comfortable with the no trade days. And I'm talking to myself too. We got to get comfortable with some days just being a no trade day. Some days are a no trade day. I think I had mentioned in the last masterclass, one of the reasons why I really don't like Top Step is because now they have a rule where in order for a day to count towards a payout, you have to make at least $150 on that day. And it's like some days are no trade days. And then I have to make a certain amount for it to count towards a payout when some days are only a $50 a day. So that just forces you to overtrade, trade what's not there, or take a bigger risk than you're willing to take just to be able to earn a payout, which I don't like. And also the whole, it's just one more trade. It's never just one more trade. That's one of the issues with futures is that you can trade as many times as you want. There's no limit at all. You can take 300 trades a day if you want. No limit. There's no one telling you to stop. So you got to be careful with that. Now let's get into my futures trading style. My personal futures trading style, I traded kind of like I was trading Forex, to be honest. Very momentum-based strategies only. Higher time frame, clean structure. That's just what I'm used to. Some traders that kill it on the smaller time frames, but I'm not used to that. And so for me, it's just like, if it's not broke, don't fix it. Whatever you started with, or whatever you're comfortable with, try to see if that can work with futures. If it doesn't, then switch it up. But if it works with futures, use it for futures. High probability setups. So ORB zone, bounces and breakouts. We've been talking a lot about ORB in the Discord lately. Trend line, bounces and breakouts. This would be an example of that. This is a trend line break, right? You would get it right here on this retest candle. And then support and resistance, break and retest. These are my favorite momentum strategies to use for futures. And I focus on base hits, not home runs. Home runs and holding runners and all that, I use options for that because it's limited risk built in with that, with the premium price. But when we're talking about things where I got rules to follow, got capital to protect, I'm working towards payouts, and I'm also having a stop loss on every single one of my trades, I'm focusing on base hits, taking the money and going. I can get in again later if I need to. But as far as like holding on and this, no. Or even letting things go red, I'm so quick to move something to break even. There's no reason to let something go to red if you can stop it with futures. I will move that stop loss right there at break even so fast. There's no need to be taking big losses, okay? Base hits. When I trade futures, this is what I have noticed. And this, honestly, this is the cheat code, y'all. Y'all need to write this down. This is the cheat code. I know other traders have noticed this, but it's definitely a cheat code. There are specific hours where certain setups present themselves almost all the time. I have trained my eyes to look for certain setups during these hours. 9:30 to 11, that opening hour, power hour, I'm looking for breakouts. Lately, I've been loving that first 15-minute candle, that 9:30 candle ORB breakout. Love that. And it usually will break out between 9:45 and 11. So I'm looking for breakouts from 9:30 when that first candle's starting to 11. I'm looking for a breakout. 11 to 2, what I like to call the lunch dump. I'm looking for rejections. All right, we're in a bull market. Usually whatever has happened in the beginning of the session has reached a resistance area and it's looking to reject. To reject, looking to retrace, looking for rejections during that time period. If I'm trading during that time period, I'm looking for rejections. And then I'm looking for bounces during that last New York session power hour. 3 to 4, looking for bounces. Because usually after the rejection has happened, after the retracement, we have gotten back to a bounce area and we either bounce or consolidate for the last hour of the day. This is what happens almost every day with trading. It's almost like too predictable, right? So breakout, reject, bounce, like it's the same thing over and over and over again. And I'm telling you, trading should feel boring like this and predictable like this. All right. The hard part is knowing where it's going to break out, where it's going to reject, where it's going to bounce. But as far as when, this window of time has not been failing me. So write that down, write this down. Eventually it just becomes second nature, but at first write it down. Thank you, thank you. All right, beginner-friendly futures strategy framework. I put no freestyle trading allowed because you can't be freestyling with this. It's so embarrassing because when I first started with futures, I was like a kid in a candy store. And my P&L calendar was showing 100 plus trades, y'all. I was just getting, trading all the time. I was just having fun with it, to be honest. I was hyper scalping. I was doing all kind of stuff. Testing different strategies, not only for myself, but so I can teach y'all. So I was just going crazy with it, right? But don't have too much fun. Get boring, get strict, get consistent. Start with one setup, one directional bias. So back to this page here. Start with one of these time frames and look for this directional bias or type of trade. Breakout, rejection, bounce. One entry trigger, one stop, one target, aka your risk to reward ratio. I swear by the 1-to-1 risk to reward ratio. I outline that a lot in my book also about why it's not only really good for profits, but it's also really good for psychology to do 1-to-1 because you win so much with 1-to-1 risk to reward ratio. It builds so much confidence. The more trades you win, the more green days you see, the more confidence you have, and the less hesitation you have when getting into trades. If you can actually see the last 5 times I entered, it was good. So why would this type be any different? It just builds confidence, builds consistency, makes you stick with your rules as well. When you see that, okay, it's constantly hitting my profit target. When you are trying to hold on to something to hit a 1-to-5 risk to reward ratio or 1-to-3 risk to reward ratio, it may have been in profit for so long, but never hit that 1-to-3 and then goes down and hits your stop loss. But you were green, you were in profit for so long. It just never fully got to the profit target because you made the profit target 3 times what your stop price was. You would have had a 1-to-1 risk to reward ratio. It would have hit your profit target. What not to do as a beginner, trading news impulsively. I would actually say don't trade news at all if you're a complete beginner because that's where you can blow accounts. Free game here, especially FOMC. FOMC will really blow your account because FOMC, when Jerome Powell, and I guess we're having a new guy soon here, I don't know, but whenever the speaker is speaking, it's so funny because it happens every single time. And it's like, well, as soon as he comes on the screen, oh my God, we like popped up or we popped down. And then as soon as he starts talking, we pop down. And it's just like so much volatile swings. It'll hit the stop in both ways. So just let it do what it does. Let the speech happen. Let him say what he says and then get in when the market has actually chosen a direction. Because during the FOMC meetings, it's just a chaos war. It's literally just chaos. Okay. Now, me, I love trading CPI. CPI, I'm gonna trade every time because CPI is so predictable. It pops at 8:30 and then it drops. It's so predictable. And it's been that way for the last 2 years, specifically the last 2 years since we've been in the bull market. Almost every CPI has been a pop. I think there's been one that wasn't a pop. Okay. But options, I wasn't able to trade that pop because it happens at 8:30 a.m. On futures, you can trade that at 8:30 a.m. To trade news, you need to back test news. Like I said with CPI, don't take my word for it. Go back test the last 24 months of CPI. Look at the dates for the CPI, which is usually in the middle of the month. 8:30 a.m. on CPI day. Look at what happens on NQ and let that be your bias going into the next CPI because it's a pattern that has created probability and a high probability at that. So it's not guessing, right? It's just following the pattern, following the probability. Now, another thing to worry about when you are a beginner, don't size up too fast, especially when you start making money or you've gotten into the groove where it's like, whoa, this is kind of easy. Let me add more size. Don't. Stay with the size that's working for you. Trading all day, over trading out of boredom, trading just cause. That will really get you. The fact that there's no rules on how much you can trade with futures is probably one of the biggest cons. don't break your rules just to make it back, okay? Don't move your stop further away just to avoid it hitting it, just so that you can make what you just lost back. You need to have a very, very strict plan. And I'm going to have a masterclass, y'all, because I have a notes section in my phone that I've been adding to for years. And it's crazy because over the years of trading, I've gotten more strict. You would think I would kind of loosen up. I've gotten more strict. As time goes on, I've gotten more and more strict with my trading and I keep adding rules as I go. Okay. Also, comparing yourself to others, that's a big thing too. I've been on threads a lot lately, and even I've gotten into the headspace of like comparing myself to other people. There's this one girl, she trades not micros, she trades minis on NQ, and she will be like 30 contracts deep in NQ. What? And she just holds for like 10 seconds and made $10,000. And it's just like, I'm nervous watching it. I'm nervous watching the candle doing what it does. I can't even imagine the guts. And she's trading with her own capital. She's not trading with prop firms. I can't imagine, but it's inspiring. She records herself when she's trading and she just looks so calm. It's very, very inspiring. But that's not me yet. But that may never be me. And I got to be okay with that. The psychology of futures trading, once you kind of get used to the prop firm rules, get used to trading itself, get used to looking at these time frames certain type of way, it can feel like, oh, this is easy and predictable. The mindset, the psychology is going to be the thing that's always evolving, devolving. It's going to be the thing that you're going to have to constantly work on. Fast wins can feel addictive. Losses can feel personal. Discipline is going to beat dopamine. At first, it's not going to feel that way, but if discipline is going to win every time. Discipline is going to get you where you need to go. And boredom is dangerous. Another side story. Sorry, y'all. I have so many side stories. I follow this other girl. I love following girl traders because it's just so inspiring. I follow this other girl trader and I follow her on Instagram. She's killing it. Options trader. She just bought a home. She got everything she wanted last year. She got a home. She got the cars. She got the vacations. She checked off her vision board, essentially, right? And she did a reel where she was talking about how bored she is. She's like, I got everything I want now. I'm making thousands of dollars a day. What else is there? You gotta have hobbies. You gotta have hobbies and you gotta have purpose outside of trading. And this is another reason why I tell people that still have jobs, especially if it's a remote job, don't quit your job so fast. Even having a job as a distraction or something to do or another purpose to fulfill will really keep you in the trading game longer. And then when you still have your job and you're making money with trading, you not having to have a job is going to make your job less stressful because you know you don't need it, right? But just to have that side thing that's occupying your mind, that's occupying your time. As a mom now, I don't trade as much as I did before. I can't. I ain't got time. I don't have time to sit at the charts all day. I've also been taking more precise and I would say better trades because I'm a mom. Because I know, okay, I'm not about to waste my 3 trades a day. You know, be really intentional. I got to put more care into it, knowing that it's not something I can sit at the screen and do all day, right? I take my money and I go. I don't overthink about it because I got other things that I'm doing. So yeah, beware of boredom. Boredom's not good. Your beginner futures roadmap. Step by step, learn contract mechanics. We kind of got in the beginning of the masterclass. Paper trade, all right? Demo trade. Sign up with Tradeify. Tradeify will allow you to demo trade on their platform. They start you out with a $50,000 account. They will allow you to demo trade for 2 weeks per email address. Okay, if you got 5 email addresses, that's 10 weeks of demo trading. Demo trade. Don't do these evals trying to learn because then you'll start resetting and paying money to reset. Then you'll start paying money month to month. And you don't want to get into debt before you start trading. Like paper trade first. Pass the prop rules mentally first. So what that means is when you are demo trading, still follow the rules that you would be following for these prop firms. Luckily for us, for the prop firms, they have all their rules on the website. It may be a little hidden, but at some point on the website, on some page, they have all the rules laid out. Screenshot it, write it down, and trade your demo account following those rules. So you've already gotten into the habit of following the rules. You've already gotten into the habit of the daily loss limit. On Tradeify, it'll allow you in the settings to set up a daily loss limit. Set that up to whatever your prop firm regulations and limits are. Trade micros. Don't trade minis, y'all. Even if you can stomach it, just don't do it. Don't do it first. The girl that I mentioned before, trading with her own capital, 30 contracts deep in minis, she's been trading for 6 years. She's been trading futures for 6 years. Start with micros. You can scale it and scale slowly. Protect your capital at all costs. This is for the people that are going to trade with their own money or are going to start getting these evaluation and challenges under their belt. Protect your capital. Put yourself in a strict schedule. Don't reset your account. A lot of these companies, they'll be like, oh, you can reset for $100. That adds up every reset you do. Protect your capital at all costs because, again, you not want to be starting trading in debt or trying to make back what you lost. It's avoidable when you're learning. Who futures is and isn't for. Futures is going to be a good fit for you if you like structure, if you can follow rules, if you prefer the fast markets, you like to get in, but also for those that can sit out when there is no setup. Okay, this is the people that know how to sit on their hands, even though they don't have to. All right, who structure, even though it looks like a playground, you need to follow structure. It's not a fit for you, or you're not going to make it in the futures game if you don't use a stop loss, period. You got to use a stop loss. You have to. If you hate rules, it's not going to be for you. If you're used to or wanting to chase excitement, it's not going to be for you. And if you don't like scalping, it's not going to be for you. A lot of futures is scalping. Even though I use the higher time frames, I still scalp. It's still scalping. It's just using the higher time frame for my levels. But I'm still scalping. Futures is a scalper's game, especially with the whole no overnight holding thing. All right, now it is time for the Q&A.
I have a question. So when we're doing an eval, do you recommend starting with a lower account or the higher account?
No. I'm so glad you mentioned that because I really want to get into a video on YouTube, but I don't really know how to title it, how to frame it. But I want to talk about how your account, what you're trading is not what the account is. You are trading your maximum drawdown. The maximum drawdown is what you're trading. I have 150K accounts with Tradeify. I'm not trading $150,000. My maximum drawdown is $6,000. That's what I'm trading. I can't lose 150K. I can only lose 6,000. I think of it like that. I don't have a 150K account. I have a $6,000 account because that's my max drawdown. I can only lose $6,000. I can't lose 150. So I say go the highest that they have. I know Apex has 300K accounts. Highest that they have that gives you the maximum drawdown because the more drawdown you have, the more money you can lose. People be like, why get 150K account when you're not ever going to trade 15 mini contracts? Because a lot of people get these higher accounts so they can trade more contracts. I will never trade 50 mini contracts at a time. That's not why I got 150K accounts. I got 150K accounts because it has $6,000 that I can, up to $6,000 I can lose. It's hard to blow an account the more drawdown you're allowed. So get an account that you can afford that has the most drawdown allowance. That's really the cheat code that I don't hear people talking about. Like I really think of it as I have $6,000 accounts. I don't even think of it as $150,000 accounts because I can't lose that. I can only lose 6,000. So get the most wiggle room you could possibly have so that it's hard to blow. And as long as you don't blow it, you can keep working towards your goal. Do you recommend copy trading with multiple accounts? I do. Copy trading is a huge benefit of futures trading.